There's a bit of a market smash happening right now, so grab your second coffee of the day, or maybe something even stronger, and let's go over what's happening. I'm Shae Russell, and welcome to this special edition of your Mining Minute, or more of a macro update, and it might take slightly longer than usual. First of all, what gives? Now, I received several messages from friends yesterday asking on a scale of 1 to 10 just how are we? This doesn't help that there was a sea of red on Monday. The US market tanked and it looks like it's taking global markets with it. Major indices were pushed down overnight, and this can be intimidating for new investors. In fact, it can be pretty nerve-wracking for all investors. These feelings of unease are then compounded when you see traditionally price-stable, multi-billion giants showing falls in excess of 3 or 4% for just one trading day. Throw in sensationalist headlines that don't provide context to what's happening, and people are easily spooked. So what's driving these falls, and just how serious is it? Well, there's a confluence of factors driving the market at the moment. Major indices in the US and Australia have been knocking on all-time highs for several months now, largely fueled by the AI boom, so a sell-off was due. Furthermore, Wall Street in particular has been looking for any hint that rates would start to come down and end the tightening cycle from the Federal Reserve Bank. Last week's jobs report in the US showed unemployment rose to 4.3% in July, exceeding expectations, and this report was interpreted as proof that the Fed is behind the curve and needs to lower rates. Whether this is really the case, however, remains to be proven. Already this gives us hair-trigger traders with markets bobbing along at all-time highs when an important currency trade sees changes made to it. That is the dollar-yen carry trade. The dollar-yen carry trade is where investors borrow a currency with a low interest rate, like the Japanese yen, and then reinvest the proceeds in a high-yielding currency such as the US dollar. Last week, the Bank of Japan raised interest rates to 25 basis points, which means the cost of borrowing money in Japan has increased, not only reducing the profits on the dollar-yen carry trade, but also strengthening the yen against the US dollar. Foreign exchange traders have long been aware of the impact raising rates in Japan would have on currency markets, so it's not a surprise to anyone in forex or bond markets. So a major Japanese index falling more than 10% in one day, while intimidating, is very much a consequence of the Bank of Japan beginning to unwind decades of easy monetary policy. The spillover into global stock markets certainly is alarming, but without a further crisis hiding as an undercurrent, it doesn't mean the end of days is here. However, it is a timely reminder of just how interconnected and sensitive to rate changes global markets are. You also can't ignore the impact of two of Wall Street's favorite tools, that is automated trading and leverage. The sea of red you're seeing on your screens right now is exacerbated by algorithmic trading dumping trades that a human might not. Then we've got leverage. Now, using leverage to increase the investment size is a prized tool of Wall Street, as it allows people to take on bigger positions than their cash stores allow. Right now, these leveraged accounts would be experiencing margin calls, that is asking for more cash to be deposited to keep the positions open. Those who can't meet the margin call will downsize or dump all of their positions, driving prices even lower. Right now, we have a gnarly conversation of markets at all-time highs, itchy trigger fingers looking for a Fed rate cut, the unwinding of a major institutional currency trade, algo trading dumping positions, and possible margin calls. So it's no surprise that there's differing views on what comes next. Some are calling for an emergency meeting from the Federal Reserve Bank, claiming the central bank needs to cut rates immediately, though without a serious financial crisis, that shouldn't be on the table. However, the president of the Chicago Fed reminded markets yesterday there is nothing in the Fed's mandate that is about making sure the stock market is comfortable. Finally, if you're new to markets, remember this: a 10% fall is considered a price correction, and a 20% fall is considered a market crash. What we're looking at is probably just a price correction. Believe it or not, we here at mining.com.au have been working away at launching a macro podcast with a focus on the mining sector. It launches in a couple of weeks, so make sure you tap the like button so you're notified when it drops.